So
yeah, Simon Black, Chris Martinson, Adam Taggart, Amigos, Peak Prosperity, Real Estate Guys Cruise. Is that okay?
Yeah, and we met the first time last year.
Yeah,
that was pretty cool.
Yeah, had a blast. I spent a lot of time hanging out with Adam until
that was a late
way
night.
Early in the morning. Yeah, and there's just been so much going on in the world. This is a really cool event. I've talked about this with my audience. I know you've talked about this with your audience. This is, for me, I don't speak at events. So this is always a special thing for me. We get tons and tons of invitations every year. Mm-hmm. I turn down pretty much every single one of them. I don't even like to do podcasts, really. I'm so busy I've got so many businesses I'm running, so many things I'm doing. But I always make time for this one just because the quality of the people here, and you guys, the Kiyosakis, etc. And Ross and Robert are just such wonderful guys. Yep. I've gotten to know them so well over the last, I can't believe it's been 5 years. Went to the alumni dinner. They gave me 5 years in a row. I got a pair of pants with my name on it that I traded with Peter Schiff's wife because she had large and I had medium. And
so she's walking around with your name on her.
She's walking around with pants that say Simon. And I came back from dinner. I went to the gym last night with Lauren Schiff's pants on. So I went down to the gym in the lobby and it says Lauren all over my pants, but hers are like extra large, and so I looked like MC Hammer. I mean, the crotch is like hanging down to my knees and stuff like that. I'm like, I look ridiculous, and they're Lauren Schiff's pants. So anyways, and this is like day 2, so we've got another week of this. We're going to, it's a cool thing doing this on a boat, so we're going to San Juan. I think we're getting off, and I have a business. I have a bank. One of my banks is based in Puerto Rico. Really? Peter's bank is based in Puerto Rico, and he actually lives there now. And I think I'm getting a bunch of friends of mine who are living in Puerto Rico to come and meet us. We're basically going to crash the party.
Cool.
And maybe one of my attorneys and accountants there is going to come out and talk about what's happening in Puerto Rico and so forth. Kind of an interesting thing. Obviously just got wiped out by the hurricane.
Oh, that was awful.
You'd be surprised. Yeah, it's still pretty bad, but you'd be surprised. There are parts of San Juan. It's kind of interesting what's happened. Maybe just interesting to get your take on crypto. So many of these guys that have made tons of money in crypto are sort of making Puerto Rico their home now. They're calling it Portopia or something like that. And
I've heard about that, right?
Right. There's like 10,000 crypto conferences, going on there now, and a lot of these guys have actually bid up the prices of real estate. So you'd think that after that, just horrific hurricane, that everything would be dirt cheap and so forth, but it's not.
That's interesting.
It's actually not. Yeah.
You mean just in this one enclave where Cryptopia is going on? Or?
Yeah, there's a really the kind of one of the nicer parts of San Juan is called Condado, and the prices of real estate in Condado are not cheap at all. In many respects, they've actually gone up since the hurricane, and so there's a lot of these guys are coming down. They're just scooping up all these apartments. We send a couple of our guys to Puerto Rico recently just to scrounge around and try and find some semblance of great value in the real estate market, and couldn't come up with anything.
Really?
Oh yeah. Wow. I mean, it was pretty surprising. I mean, there's some okay deals here and there, but the thing that really surprised me was by comparison, just other territories right next door. U.S. Virgin Islands and St. Thomas, I think it was. The real estate was actually so much cheaper in St. Thomas than it was in San Juan.
That is really interesting.
Yeah, I mean, it was kind of wild. So Peter, I've been friends with Peter for years, and he's been trying to convince me for the longest time. He's like, you got to move to San Juan. Yeah. I think maybe he's lonely. I don't know. So he was trying to sell me on the idea of buying the condo that's like just underneath his. I was like, I don't think I want to live underneath you. So I think we'll do that, and then we're going to St. Thomas and then St. Martin. We'll get off the boat in St. Martin. I don't know if you guys are going the whole way. But
we're going the whole way this year. Last year we popped off, I think, at the first place we stopped at Roatan. This year we get to do the whole thing.
So, do you live in Maryland still?
Massachusetts.
Massachusetts, right. And where are you, Adam?
I grew up in Massachusetts, but I'm now out in the People's Republic of California.
Okay, yeah, very nice. And the Northern Republic or the Southern Republic?
The Northern Republic, okay. Yeah. We're actually up in wine country in Sonoma County.
Okay. So for my audience, you guys run peakprosperity.com. Really interesting website. We have such a philosophical alignment, obviously. Maybe, just kind of a quick sense of maybe your oil view. I think your views on energy. I mean, you talked about that last year, and I unfortunately missed your remarks this year. I got cornered by either Ross or Robert, I think, during your remarks. But maybe a sense of the some of the energy things we're talking about with respect to GDP growth and how all that's really changing right now.
Well, sure. The primary mission of the website is to give people really high quality information that they're not going to get anywhere else. Kind of that's the philosophical alignment with this conference and with yourself. There's ways you can look at data and determine for yourself what's going on here. So our view is you can't look at the economy in isolation anymore. You've got to understand the role of energy in the economy and then also ecology or the environment. Look at all three of those and you can get a sense of where we're going, right? Not from a futurist, as Yogi Berra said, predictions are difficult to make, especially about the future, right? No, but trends you can extrapolate. And it almost looks like magic to people who don't know how to do that, but what we're doing is just extrapolating the trends. Here's the data, here's where it's going. And our prediction is it's going to keep going that way unless something changes, right? So with energy, some of the big trends people have to know about is that 2015 saw the worst year of oil discoveries since the 1920s. And 2016 was worse than that. And 2017 was worse than that. So oil is farming with a lag time built into it. So if you want to have oil coming out in 7 years, you have to have done the exploration and the discoveries 7 years ago.
Right. It's a great analogy. It's the same. It's very similar with farming. I mean, we started one of the largest blueberry producers in the world. You got to plant those things, and then you wait, and it takes time for them to grow. And and
you hope supply and demand is in your favor when that happens. When the harvest comes. So, what people need to be aware of is that no matter how aggressive we decide to get at throwing money at an oil supply problem in the future, there's a hole in discoveries, which is really dramatic. It's the worst in the series. And is the world using less oil? No, we use about 1.5 million more barrels a day every year, year after year, barring a major recession. Right? 2008, 2009, we saw a little downtick, but otherwise it's a long, unbroken series. Right? So every headline anybody's read, like the age of oil is over, it's pure marketing. It's there to deceive or prey on people's hopes. Right. Like, I really hope we get off oil. Well, that's great, but the capitalist in us knows, wow, you got to find lithium, you got to mine it. There's hopefully enough cobalt. You got to get your manufacturing supply chains, and then eventually you'll have enough cars to sort of dent the oil demand. But we are so far from that moment. So oil still
for electric cars.
It matters. Yeah, sure, it matters a lot. So that's our view: is that the shale plays are a flash in the pan. You drill them. You get this great flows, not great, maybe 400 or 500 barrels a day at the start. That's not bad if you're in the business. But it's 85% gone. It declines 85% in that first 3 years. Yeah. So as long as you're drilling like madmen, it's great. You can sort of keep it up. But think about a feather that you're blowing in the air. Right? You have to keep that stream of air going. And as soon as you let off of that, the feather comes back to earth quick. Sure. And we already have 3 major shale basins that are past peak. The Haynesville, the Barnett, and Fayetteville. We started drilling those in 2006-ish, and they peaked each in 2016 or 17, and straight down. So they're great. I'm not saying don't go after it, but this idea that the United States is the new Saudi America forever is not the right story. And people who are buying that story could make huge mistakes, right? Those sea-level strip malls that are like 90 miles from any place, the housing suburbs that depend on people commuting by car for really long distances. Those are going to be the kinds of places for the real estate crowd that are going to get really whacked when, not if, oil goes back to $5 a gallon, $6 a gallon at the pump. And this is all barring the most recent John Bolton desire to go attack Iran and the Strait of Hormuz gets into play. Like, this is no geopolitical events. We're just saying the investment hole that we saw was so extraordinary that we know there's a supply hole in the future. It's just farming.
Right. So we were just talking about it before. I mean, right when we came up here, all hell broke loose in Syria yet again. So, let's talk about that. I mean, it was very interesting, just the timing and the sequence of events. There was an event, there was an immediate reaction, there was blame assigned, and all these things. I mean, it seems, you would say, almost obvious that there's just a very strong desire to take deliberate and significant action, whether that's even potentially military or otherwise. So let's talk about Syria. This will probably be later today or tomorrow when this goes out. But for people that haven't seen, tell us about what happened in Syria.
Well, there was just another gas attack, apparently. So all we really have so far are social media tweets and videos that come from the white helmets.
Right.
People who aren't familiar with the white helmets, they've been caught many times staging attacks with crisis actors. They put gray, dust on them and film them, and then later they're all like hugging. You when you see the before and after photos, you realize this is just a made for
propaganda
TV production. So this is the group that's putting this out. There ought to be some skepticism around that fact alone. But again, what we're seeing is the verdict preceding the evidence. So there was a gas attack in an enclave. The rebels are just squeezed down. The Syrian government's gotten totally surrounded. Last desperate act, and it's in a suburb of Damascus called Douma. And so this is where it allegedly happened. Again, we would say, who benefits? What's the motive? What possible motive could the Syrian government have for gassing women and children? Just a few dozen of them. Has no military advantage, but has an extraordinary possible disadvantage if NATO says, well, that's it, that's our red line. And of course, Trump tweeted instantly, this is horrible, what an animal, big price to pay. So who knows by the time this goes out if another 60 Tomahawks have been launched and sent in there. Preceding this was the Skripal case, which was the ex-GRU agent who was got caught being a double agent and was living for 6 years in England, and then him and his daughter Yulia were poisoned in a somewhere in Salisbury. We don't know where. And the interesting thing was the British government had this shifting story about what happened. Oh, they were dosed in the restaurant. We had to decontaminate the whole thing.
Right.
But if you were there, just wash your clothes. You'll be fine. So it's the most powerful nerve agent known to humans. 8 times worse than
just throw in the wash and be all good.
Yeah, use extra detergent. I don't know. Wash your. And then they said no, it was in the air vents of their car. And then they said, oh no, it was actually on the door handle. Wait, it might have been the buckwheat, cereal this guy had. So there was this shit, like they didn't know their ass from their elbow in terms of what happened.
Right.
And if you don't know how somebody got dosed, it's very difficult to say it was you or it was you, right? You can't do that. So it's all been shifting, but what didn't matter was that evidence. So there was this rush to judgment. 150 Russian ambassadors were expelled from a variety of countries, 60 from the US, 23 from the UK, and so on.
Right.
And so this led to, in anybody listening to this, this is worse. This is the worst relations with Russia at any point in my life, and I'm 55. This is worse than the Cold War by far. And that's the backdrop. And so tensions are really, really high. And then you have this gas attack in Syria. So the concern that
with the same timing, just immediate rush to judgment, blame. Yep. The tweet storm starts, and then we'll see what the next reaction is from there.
Right, and you have to understand that Russia has been saying for weeks, we suspect that there's going to be a false flag gas attack in Syria. We don't want anybody to believe it, but if you do that and then attack us, we're going to fight back.
Right,
and so
that's the important point, right? So it's like everybody's got a breaking point, and they sort of in a way have pushed up against the Russians, and now they're saying, hey, if you continue on with this and you actually want to stick your finger in our eye, there's going to be consequences to that, and we're going to do it. We're really going to do it. And so it's unfortunately we're going to be on the boat. So now I'm going to have to get the internet package to find out
you and me both.
I know what's going on. Yeah, the $10,000 a day internet package on cruise ships. So yeah. I want to go back to energy. One of the things that clearly this has significant implications in a number of different things. I mean, we've seen volatility in the markets. We've seen, my remarks. I talked a lot about interest rates. I know you guys are talking about LIBOR and what's been going on in LIBOR. I mean, for me, my story was just looking at U.S. government debt and saying, look, you've got. I mean, they auctioned off $300 billion in a single week, a couple of weeks ago. I mean, that was the entire national debt during the administration of John F. Kennedy.
Right.
And that just in a week, and the Treasury Department's estimates are $1 trillion this year, $1 trillion next year, $1 trillion the year after that, and that doesn't factor in, as we were saying, recession, any kind of crisis, natural disaster, even war, trade war, shooting war, anything. I mean, and so that has consequences, especially when the Federal Reserve and the Chinese. Why would the Chinese be stupid enough to buy, more, to double down and increase their stake on U.S. debt? It doesn't make any sense. So all the usual suspects who are buying up all this U.S. debt for the longest time are now saying, no, we've ended quantitative easing, or we don't want to support you, say the Chinese or the Japanese, who need the money back home for their own economic issues.
Right.
So you lost 90% of your buyers, the people that are buying up 90% of your debt over the last 10 years. And the only answer really is that it has to go out to the market, which is fine. I'm sure it'll be mopped up by the rest of the financial system, but at a much higher cost.
At a higher cost.
Right. So you've got interest rates that are increasing, and as interest rates increase, it creates this reflexive, self-perpetuating mechanism where they have to borrow more money to pay interest on the higher rate, which means they go deeper into debt, which means they have to issue more debt, which means interest rates go up, and they issue more debt, and interest rates go up, and it's this negative feedback loop, this cycle. And we're starting to see the very early signs of that. We're starting to see the very early signs of the effects of the interest rates. It's everything kind of calmed down for a couple of days with the trade war in China, and then they said, it's almost like somebody in the White House has a massive long position in the volatility index. Because as soon as things calm down, like somebody called, "Yo, Trump, say something crazy." Tweet. Yeah,
shaking.
Yeah, I mean, it's like somebody here is like making a ton of money on the volatility in the marketplace. Because as soon as things calm down and they have to do something crazy and then the market starts to flop, and so volatility spikes, and then people are starting to factor in, the thing that's been interesting to me is this paradigm of, hey, it's perfectly fine for companies to not make any money. You've had all these companies that have been hemorrhaging cash, negative free cash flow. And all of a sudden, Tesla was sort of the canary in the coal mine. When people start saying, well, not only has the stock price been falling, but the bond price has been falling.
They have to make money.
Right, yeah. What a shocker. Like, people actually in the
That is a rude moment.
Actually, yeah, I know. What a wake-up call. And now, on top of all this, we've got, the Russia situation. Where do you think this impacts oil?
Well, gosh, I mean, if we get into any sort of kinetic confrontation with Russia, I think the price of oil just goes bananas, right?
Do you think that affects natural gas as well? I mean, natural gas is sort of a fragmented marketplace where we see
doesn't ship well.
And prices and right, exactly. It's still very early stages of that. But oil on the other hand is very much global, unlike natural gas. Where do you see kind of all this affecting markets?
Well, you had a really important data series, and I just want to add one more to that, which is that the commercial grade corporate paper market is also trading at the highest yield in years, right? And so if you're looking at the corporate buybacks, that buoying effect, there's been a number of key players that have been really buying the heck out of the equity markets, and stocks are what people mostly focus on. But bonds is where the action is going to get ugly, when it really goes ugly, right? But let's just look at equities for a minute, because that's where people get their headlines, and a lot of people have their money invested there. Corporate buybacks were really one of the largest drivers of the recent rise in equities. I mean, it was very big. I'd put 50% explanatory factor on that alone.
Oh, easily. And then, if you consider as well the lift in earnings per share as a result of corporate buybacks.
Right.
I mean, not just even the stock price,
right.
but, when people say, earnings per share up. Well, there's a reason why earnings per share have gone higher is because they took so many shares out of circulation.
Right. So if you look at revenue,
right. If you just look at revenue, the revenue growth has basically been nothing.
Right.
If you look at earnings per share has increased. So it's like, well, what's going on here? Clearly, they're just taking their shareholders' capital and they're buying back all these shares, taking shares out of circulation. You decrease the denominator, and the overall number goes up.
Right. So listen, I'm not going to fault a CFO of some company that says, look, I can borrow at 2% and I can retire a stock that's yielding 3% on a dividend basis. Go do that. Do that all day long. But they were going out into the debt markets, right? And just borrowing like crazy. When does that gravy train stop? Well, it stops when those numbers no longer make sense. Right? If I have to borrow at 3 to retire at 3, now you have to, that's hard. But if you have to borrow at 3.5 to retire at 3, now you're going to get fired. You should.
Well, I will fault the CFO for that. The CFOs and the CEOs and chairman of the boards for that, because I'm the chairman of a publicly traded company that's listed on the Australian Securities Exchange, and we invest in U.S. real estate actually. And so one of the things that's if my company, if the board, if we looked at this and said, okay, our book value, our net asset value, and so forth is at, I'll just make up numbers and say $10, but our stock price is at $20. So our market value is so much higher than realistically the intrinsic value of the company. And then I took the shareholders' money or even went into debt to buy back shares at a dramatically higher price than what stuff was actually worth. I should be fired.
True.
I should be fired for that. My responsibility, and I think any executive's responsibility, is to make sound investments. And what we should be doing is buying things that are accretive to shareholder value and not destructive. And I think that the entire idea is that we should be out taking capital and buying undervalued assets, not our own shares, which are being overvalued by the market. If the share, if my book value was $10 a share and my share price was $5 a share, that would be brilliant. That would be brilliant. Of course, I should take shareholder capital and buy back all these shares, because that's actually a great deal for all the rest of the shareholders that are hanging on. Shareholders that want to exit at a 50% discount to book value, if they're dumb enough to actually sell their shares at that level, then hey, great, we'll go ahead and buy them, and that's great for all the other shareholders. And to me, the fact that all these executives have spent the last several years going into debt to buy back shares at all-time highs at levels that are, have only been seen, valuations that have only been seen before prior to the Great Depression, I'd look at that and say that is reason enough to sell everything. I mean, to me, all those guys should be fired.
Well, and it'll all turn out to be absolutely stupid when they have to reverse that process,
of course,
and issue equity to retire the debt, because that's the other side of the story.
Exactly.
Right, at some point.
Exactly. I mean, whenever you get into a situation where where debt's too high, it was one of the things that I was talking about in my remarks. Is that there have been a couple of agencies that have gone through, some analysts that have gone through and looked at companies in the S&P 1500. Which a lot of people don't know there is an S&P 1500. There is an S&P 1500, which is obviously even more encompassing the S&P 500. And they looked and they had to filter out some companies that didn't have enough of a track record. They looked at the last 3 years and they came up with about 1,100 companies that had 3 years worth of track records, and found that 14% of those companies had EBITDA that was less than their interest expense.
Yeah, I remember that.
So it's not even you're not even talking about debt multiples and so forth. 14% of the 1,100 companies had interest expense that was greater than their ability to pay interest. So essentially, they're the federal government. They have to borrow money just to pay interest on the money they've already borrowed, and so exactly it's that. The market's been very accommodating of that, because they people invest in stories and they say, oh well, this is going to have some huge market share, and at some point down the road they're going to make all this money, and so we're just going to keep they're going to keep hemorrhaging losses and keep going deeper and deeper and deeper into debt. And certainly there are some business models that do require, for the first several years, oil exploration or whatever else, that do require, hey, we're going to lose money for the first several years, and then hopefully we're going to make lots of money after that. But in this particular case, it's like the entire business model is almost, we're never going to make money. We're just going to. As I was talking about in my remarks, WeWork and all these guys that it's like they just don't care. They take their shareholders' capital and they buy margarita machines.
Did you hear what the CEO of Netflix said?
Reed Hastings.
Yeah.
What's that?
Go ahead. Yeah, no, I was thinking of exactly this.
Yeah, so I don't remember the exact quote, but it was he basically said in a shareholder meeting, in an investors conference call, he said, look, the more we burn cash, the better things are. Because what we're doing is we're spending that money building these intellectual property assets, and the more of those we have, the more we're worth. So he basically said, trust us, we're going to do these really special programs, we're going to produce more Breaking Bads and all this, and that's going to of course be positive for us, but it hasn't worked for them in any single year of operation yet.
Of course, yeah.
The story is not yet yes.
And then the thing is, like, we talk about this a lot. It's like where everything is priced, it's priced for perfection.
Yeah.
Right? In theory, if everything that Netflix could do would go according to plan, if everything was just perfect forever and ever, and there were no risks, no consequences, nothing bad ever happened, then maybe, just maybe, they might be able to pull it off. If they just threw enough money at it at some point off in the distant future, the unicorns would come out and the rainbows would shine, and it would all be fine. Netflix would make money, but it's priced for perfection. It's like we were saying with the Treasury budget, like it's even all that, it's a trillion, and another trillion, and none of that factors in anything potentially bad that might happen. And of course, you look at Netflix, and it's like they've got to deal with. They're competing with Disney, and they're competing with Apple, and they're competing with all the the traditional guys, and competing with Amazon. And those guys go through cash like it's nothing. They're dealing with companies that have way more. Apple has more cash than Netflix has market cap.
Mm-hmm.
And you're competing against those guys. They could literally burn more than your entire market cap and still have money left over. So who's going to produce more Breaking Bads and all that?
Well, and just pick one of those, right? Disney, which has basically announced that it's going to pull its catalog from Netflix within the next year or two, right? I don't have exact numbers here, but I got to imagine the Disney movies as well as the Marvel movies are a pretty substantial percentage of the content that's consumed on Netflix.
Sure.
Right? But since that announcement, I think Netflix is up like 40%.
Right. Yeah. No, that's nuts. And then, of course, you've got the Time Warner, AT&T merger. If that goes through, and those guys would have their own over-the-top service, and everybody's trying to do their own over-the-top service now. Like everybody is just getting all of their ducks in a row so that they can. What was it? I guess CBS that started theirs. Launching the new Star Trek series on All Access, and which has apparently been fairly successful for them. And so that Netflix has got to compete with everybody, and so the stock, and like most of these in the market, are priced for perfection as if they're going to achieve their outcome without any obstacles or consequences. Yeah. And I think it's the same thing if you step back and look at the big picture. In debt markets, where you look at how government debt is priced, not only in the United States but in Europe, where you still have $10 trillion of debt with negative yields.
and the European junk bond index is trading with a yield traded below 2% at one point. It's closing in on 3 now. So it was trading with a yield that was 50 basis points less than the 10-year Treasury.
Right.
US, right?
Right.
Junk debt. These are Italian shoe manufacturers.
That nobody expects to be in business in a couple of years, and you're getting 2% on your money.
2%.
It's pure madness. And so all of that, if you think, okay, nothing bad is ever going to happen forever, then maybe, there will never be any inflation, there will never be any potential consequence, no bumps in the road, no wars, no trade wars, no debt crisis, none of these things, then maybe, just maybe, it might turn out okay and 2% won't be all that bad. But everything is essentially priced as if nothing bad will ever happen, ever.
Again.
And if you exactly. And if you step back and look at the big picture, you go, there's this and there's this and there's this and there's this and there's this. And now just, again, 20 minutes ago, they're saying, Russia's behind this gas attack that may or may not have happened, and there will be consequences. Tweet. And so, God, the market was just down, 500 points or something like that
on
Friday, and so, we'll see what happens.
Simon, it is so egregious to me, it's offensive. So to me, the Argentinian 100-year bond sale was an offensive moment in financial history for me.
For me, the Belgian 100-year bond sale, which happened, a year and a half before the Argentine one. A 100-year bond sale for any country, it's like, who thinks they can predict 100 years in the future? This is insane. And for a country like Belgium that hadn't even had a government for a couple of years, they had a caretaker government, and have their own woefully pitiful finances. And then people kind of looked around and said, okay, yeah, we were able to place that. That sounds good. And then they did it in Argentina, which is a country that has defaulted, 4 or 5 times over the last 100 years. And we say, we'll go ahead and do that. And they priced it 7% or something like that.
It was 3 times oversubscribed, so I think they ticked it down a tiny bit.
It's pure madness. Again, it is. It's so. We sometimes, around our offices, we'll kick around ideas about, what's the next sort of absurd, thing that's going to happen in finance. That it's like how low will the Japanese government go? Where it's like and we always use Japan as an example because to me, I always tell people that if you can only go to one other country in your life, go to Japan, because it literally is it's another planet. There's sort of the rest of the world, even exotic places, South Korea and China and all these places in the Pacific where they still have cannibalistic tribes and stuff like that. And then there's Japan, and Japan's weirder than all of those other places put together. And it's like they could really get away with anything in Japan, where they just the government would say, well, you have to send us your firstborn and pay 40% negative interest rates in your local bank account, and people kind of go, okay, and it's just the absurdity. And I remember watching this. I remember watching Kyle Bass one time saying that they actually had it in the Japanese version of the Ministry of Finance in Japan, something on their website on the debt section where it was saying, yes, our debt level is very high. Please don't worry. That's just how they dealt with it in Japan. Is please don't worry.
I've never been able to understand why it is that the Japanese yen is considered basically a safe haven currency, because to me that's the number one major currency most likely to die first for obvious reasons, right?
I've said the same thing. Yeah, I think the order is sort of Japan, and then maybe the euro, and then
cracks up a bit.
Yeah, it starts to crack up a little bit. I mean, the euro makes me scratch my head too, because it's like you have this continent that has basically been at war with itself for 2,000 years. Right. They've had about 2 decades where they've learned to play nice with one another, and we're all gonna ride off into the sunset under this euro umbrella, where it's like this known fact that all these countries that got into euro just lied about it. The Greeks lied about it, the Portuguese lied about it, the French lied about it. Everybody just manipulated their macroeconomic statistics and so forth. Nobody really holds up to what it's supposed to be. You've got the Germans and the Austrians and so forth that they kind of do their end of it, but everybody else is just sort of it's a farce, and it's like, how does this even work? I was kind of rack my brain thinking, what happens with the euro? Does it either do the weak countries break away, or do the strong countries break off on their own, and sort of leave Greece behind? And
they were thinking back in 2008, right after that you might actually get kind of a northern euro and a southern euro.
Right.
Yeah,
which would potentially be a halfway sound currency. If you actually get the guys that are fiscally responsible and not necessarily going deeply into debt.
And then there are these sociological trends that are pressing the weight that I think is going to shatter Europe at some point. So first you just have the egregious insult of having your central bank print money, which takes from everybody else and hands it to a very select crew, right? So you have this massive wealth gap, which the Bank of England just came out and wrote a big position piece in an article and said, we don't think central bank policy had anything to do with the wealth gap. Exactly, it's humor, but they presented it seriously.
Was that in the Onion? I mean,
it was right on their website. It was a fantastic moment in central banking policy making and explanatory stuff. And then you got Brussels saying, oh, and by the way, let's just take all these refugees, right? And we're just going to insert them into your culture, and you have to take them. And talking with people, I was talking with a woman who was a newscaster, a very attractive lady, and her husband was next in line for a UN position, key one. And she comes from Belgrade. And when I asked her at this dinner, I said, can I ask you about the refugee crisis thing? And she said, turned immediately, where it's all polite chit-chat. She said, yes. So I asked her, what's going on? Within a minute, she was crying, because her beautiful city of 300,000, she wasn't safe in anymore. She can't go back.
Where was she from?
Belgrade.
Oh, yeah.
Mm-hmm. Every street corner had a group of 6 to 8, men there who were just not speaking the language and had nothing better to do and had very different cultural views of women. So her beautiful city had been taken away, and she was furious at Brussels, because basically Brussels said, you got to take them, and no, we're not going to give you any money, and if you don't take them, we're going to pull some funding from them.
Yeah, I mean the way it's such a mafia, the way the EU works. It's no wonder why you see the rise of all these sort of ultra nationalist parties and more radical candidates and so forth. I mean, it's like, what do these people expect?
Well, and that brings us to the Italian election, which saw this huge Eurosceptic movement and far right, including the ultra nationalists, come out. So all these things are just pressures on that European experiment.
Let's. I want to shift gears. You guys. So one of the cool guys that comes here. He's been here 2 years in a row. He's the chief economist at Fannie Mae. Mm-hmm. You guys sat down with him for a while yesterday. I don't know where the hell I was. I was running errands down and all over. I had to go to Brickell yesterday. And there's this music festival here. If you guys don't know, there's the Tortuga Music Festival.
I've been here.
Right next to our hotel. It's like, apparently a Snoop Dogg was around, and Keith, and the traffic was like Tortuga pace. I mean, it took 45 minutes just to get to the other side of the bridge over here. I mean, it was just all day was sitting in traffic, and I had to go down to Brickell for some business, which ordinarily is like 45 minutes, but I mean it was just like hours and hours coming and going. And so I missed Doug's remarks, and I haven't even really seen him. So you guys sat down with him, and it's interesting. Fannie Mae obviously is the government-sponsored agency, a government-sponsored enterprise that is basically there. I mean, to me, like, this is what a scam, right? Nobody even realizes how this works. You got banks that go out and make mortgages, and then they turn around and they flip that to basically to the federal government, and so they get all their money back, and they make a little profit. I mean, obviously they're not going to flip these loans unless they're making a profit on them. So they make a profit. They charge fees over here. They make a profit over here. And I look at that. It's this whole taxpayer-sponsored agency that's been set up that basically just puts money in the pockets of the banks. I don't get that deal. You guys don't get that deal. We don't get to just sell shit to the government for a guaranteed profit return, with no risk whatsoever on our part. You just get money for free, and then and the taxpayers end up paying for it. And you just go, how is this even possible? But if you really look deeper into banking, it's like that's how it works. They get these 0% loans from the Federal Reserve, and they turn around and loan it essentially to the taxpayers of the United States at interest. And so you get unlimited amounts of borrowing capacity from the Fed, and then you just turn around. It's just the easiest zero risk carry trade in the world. Borrow at zero, park it somewhere else at 3-4%, and do that literally trillions of dollars at a time. It's just a gift. Flip these loans that you don't have to actually take any risk on. It feels like communism. It's like you're basically doing something. I mean, you might as well having guys digging ditches with spoons if the whole idea is just to sort of make work projects for people. I don't understand the point of all this. And so,
well, if we wanted to be honest about it, the Federal Reserve would just wire money directly into the banks.
Right, exactly.
Profit
just
accounts.
Skip all that stuff.
That's just busy work.
Yeah, I know. I mean, it'd be a little bit more efficient that way. But Fannie Mae is they're a massive player in the U.S. housing market, particularly single family homes and all these. But in the multifamily market, I mean, we do for the company that of which I'm chairman, we do a lot. We do multifamily. We've dealt with there are different government agencies for that. And to see this stuff, I mean, it's honestly appalling. I mean, they come in, the government guarantees loans and all these sorts of things. And it's just, for me, I have certain things that I have to do out of a fiduciary responsibility to get the best deal possible for my shareholders. But on a personal level, I'm like, what in the world is the government doing getting involved in this apartment complex? What are you doing? And so for the last couple of years, anyways, the guy who's the chief economist of Fannie Mae, who's the agency, the biggest of these, it's going out and gobbling up all these loans and putting money in the pockets of the banks, basically. So he comes here and talks about the housing market, and we had some great conversations last year, and I actually interviewed him, I think, last year, but the audio was so bad because I use my mobile phone. You guys actually have whiz-bang high-tech equipment, he's not the guy that you think. He's. I mean, I was sitting there actually at lunch. I had lunch with there's me and Peter Schiff and Doug, and we were just sort of just grilling this guy the whole time about, well, what about this? What about that? And he's actually quite philosophically aligned,
forthcoming too,
right? And very candid and transparent. He was telling us, he said, the only reason I took the job, and I said I'll take the job on the caveat that I get to say whatever I want. And I said, okay. So he says whatever he wants, and he would say maybe fairly bearish on U.S. housing.
In the long term, yeah.
Yeah, he certainly was. I asked him last year, and I said, what's your take on U.S. housing? He said, it's overpriced.
Yeah.
In a word, it's overpriced.
Very, very, very true. I mean, I was trying to suss out absolutes from him, and I think he needs to be a little bit cautious about what he says publicly. But no, I think that's the gist of it. I think what he said is, look, there's still an undersupply of housing in the U.S., and until some of these more sort of macro fundamental issues that we've been talking about really express themselves, we can kind of expect it to probably limp along for maybe like another year. But he said, look, nobody knows how long expansions last, but certainly this one has lasted longer than most, and it's going to come to an end at some point.
Sure.
You then get him talking about the risks, and after you finish the conversation, you realize what he's saying in sort of economic speak is we're actually in a lot of trouble. He's just not willing to put it that straightforwardly on record. But
Yeah, and he had he relayed one anecdote from the conference. He said a young woman comes up and says, who's in housing, and said, wait a minute, who's going to fix this, right? How does this get fixed?
Right.
And he just said, honey, there isn't any fix for this. You just get too far over the tips of your skis, you're tumbling.
And that's what corrections are for. That's why they call them corrections. They're supposed to wipe away all those silly excesses, all the things that shouldn't exist, but they do exist because there's been too much excess in the system for too many years. Which is why it's always funny. It's always unpopular when I talk about Tesla. There's always people that come and say, "No, but Tesla's changed the world, whatever." It's like because it's a cult,
right?
It's the cult of Elon Musk that has convinced people that it's okay to lose enormous quantities of money with no end in sight. But I mean, in a normal market where capital actually has value and is respected by the market, by entrepreneurs, and so forth, that business, not to say that Tesla wouldn't exist, but that business model of just hemorrhaging cash, that wouldn't exist. Mm-hmm. You know, the business model of Netflix hemorrhaging cash wouldn't exist. All these business models, you know, the WeWorks of the world and so forth, like none of that stuff exists. The business model of Uber, which is essentially just a transfer of wealth from shareholders to passengers.
Right, it's a massive consumer subsidy.
Right,
basically.
Exactly. It's a
I
massive
take advantage of it every time I can. I love the free rides.
Right. Yeah, totally. I mean, I was telling some of our, I think I did it on the podcast the other day. We were talking about, you know, Dropbox. You know, they charge whatever $100 for however many zillions of gigabytes of storage. And like we run for our bank, we run our own secure servers and our, you know, file syncing and so forth. You cannot do that for $100 a year. I don't care how much scale you have. You can't do it for $100 a year. And of course, the proof is in the pudding because Dropbox is losing money. And the financials that we see, the little snapshots show that they're hemorrhaging cash. And that's just the model. And all these models are basically just transfers of wealth from shareholders, most of the time to consumers, occasionally to employees, in the case of like Snapchat, for example, where they just shower their employees with stock options and so forth. But most of the time it's transfer of wealth, you know, from shareholders to consumers, because there's no respect. Capital has no dignity. Nobody cares. It's just this you know thing to just burn and no big deal. We'll sort of see what happens. And those are all the excesses that have to be washed away, you know, when there's a correction. Hence the name correction. You know, and it's kind of interesting to see. I think that's been the general theme. You guys have talked about it. I talked about it. Doug talked about it. You know, Peter always talks about it. Robert Kiyosaki talked about it here just at this event. That clearly you know, there's been an economic expansion since the end of the recession. Has been, you know, going on 10 years of, you know, of sort of constant economic expansion. That's, you know, been one of the longest, depending on how you measure, one of the longest, if not the longest, expansion, certainly in U.S. economic history.
And also the weakest.
Certainly also the weakest. And, you know, it's one of those things that as sure as night follows day, there are these things move in cycles. There are expansions, there are peaks and troughs, and you know, we've all kind of been talking about this idea of a correction. At some point, you know, there's a decline. What do you guys do? You know, what do you sort of tell your audience? How do you get prepared for that?
But I think there's a strain that we've sort of been dancing around here. A lot of what I do when I come to a conference like this is try and talk people out of their stock portfolios.
Yeah,
like just, you know, I want people not to be holding Tesla because I'm pretty convinced that that's just going to be proven to be a bad idea. So, but that's, you know, because that's where people have their investments and all this and that. And what we're trying to do is expand first this idea that wealth is not money, right? Money is just a medium of exchange. And so if you really want to be wealthy, you need to build up all different forms of capital. And we talk about financial capital is one of 8 forms. We want people to be safe with it. If you're going to have money in the markets, make sure it's managed well, right. You know, that people understand what the true risks are. There's now counterparty risks that didn't exist 10 years ago. Yeah. You have to understand your bank may fail, maybe your brokerage, we don't know, right? Maybe JP Morgan goes down. We don't know because nobody can decipher what's going to happen in a rip-roaring correction to that 100 or that quadrillion of derivatives that are parked out there, whatever the number is, right? So a lot of what we're doing is, you know, sort of giving people the message that if you read the tea leaves, it says that there's probably a little bit less time of up, you know, there's in the story.
Right, when you've already got 10 years of up behind you, it's like how much more is there in the gas tank?
Yeah, you know, so what are you picking up nickels in front of steamrollers kind of a moment? So there's just a time. So the advice is, look, cash is a legitimate position. You want to be in cash at a time like this. You want to know what your buy lists are, though. Like maybe there comes a moment where it makes sense to buy into some of these different equities and things, maybe even the ones we've talked about, but at a lower price under different circumstances.
Where there's real value.
All of that. Yeah. And, of course, gold and real assets. Real assets. Yeah. I mean, properties.
I think one of the core topics we've been talking around here, too, and we talked a lot about this with Doug Duncan, is you know, really, there's lots of blame in this story, but I think you can place the most of it at the feet of the central banks. Right? I mean, since 2008, basically, we've been on the largest ever money printing orgy in the history of the world, right?
I mean, orgy of money printing.
Yeah, and one of the things that just
Caligula
staggers me, and I'm so glad
Don't think Janet Yellen right now.
Yeah. But I appreciate that Doug put this chart up that showed this, but and we've been tracking this for a while, but most people think in their mind, like, all right, I kind of remember how scary things were during the you know latter stage of 2008, early 2009. I kind of get that the government had to step in to keep the financial system from basically just completely seizing. I remember TARP, I remember TALF, okay. And most people think that, there was a whole bunch of rescue efforts that were done in the year, first year of the financial crisis, and then things kind of tapered off as this recovery came on. But if you actually look at the liquidity flows, they've grown in magnitude pretty much year after year after year. And 2017 was the largest year of liquidity injection into the market by the central banks.
Right.
So even though we've been in recovery, and I'm using air quotes, for the past half decade or so, the emergency measures have actually gotten greater and greater every year. And of course, all that money has to go somewhere. It sloshes around the world, and it sloshes into, you hear a lot of people calling this market now the everything bubble, right?
Right.
It really explains why capital has no value right now, because it's so easy to get and it's so cheap, right? So it can flow into idiotic business models like you're talking about, right? And so I would say that things aren't priced to perfection. I'd say they're priced to fantasy. And they're priced to fantasy because we're living in this...
It's a better word for it. Yeah.
We're living in this make-believe period right now where people have kind of gotten used to the fact that we can just keep printing more and more money month after month after month, and it doesn't have any implications, right? So that's where we're headed. And so I think all of us have been warning our listeners for years that things have gotten dangerously overvalued, and that it's prudent to be positioned defensively. And of course, year after year, we've been wrong. Again, I'm using air quotes. I don't think we will be wrong in the long run. It's just taken longer than we thought, I think, because we didn't think the excesses could grow this big or be sustained this long. And so my big fear, and I think most of us share this, is Chris uses the analogy of a ladder. In 2008, we fell from a certain rung on that ladder. Well, and it was quite painful. Now I think we're maybe like twice that level of rungs at the ladder. So the higher the excesses go, the more painful the correction is. And so, we've been advocating defensiveness. We've basically been advocating don't play the game if you can. Try to get out of the stock market. As Chris said, we're big fans of actually getting out of paper assets and into tangible assets, and we can talk more about that in a moment. But even a lot of tangible assets right now are overpriced. Real estate's very overpriced.
Sure.
So a lot of smart people, and I know you and I have talked like this, Simon, is a lot of smart people that we follow have pretty much found themselves boxed into I'm holding cash, which I really don't have confidence in the long run, and I'm holding precious metals, which I do, and I'm kind of just sort of waiting for this big correction. Deploy the cash, when we can at better valuations, but get ready, because I think what we're going to see, highly likely given human nature and how the game's been run so far, is the market probably will get away from the Fed and the central planners in general, I should say. We're going to have a painful and maybe even more painful than 2008 style of correction. And then I think the response you're going to see from the central planners are going to make what we've seen so far over the past 10 years in terms of liquidity look like child's play. And I think that's when you begin to see the bonfire of the world's fiat.
And that's why you need your buy list, because the day I get that check from the Federal Reserve for $100,000 that goes to every household, you got to get there before the next guy and buy whatever it is that's not nailed down or maybe is, right?
And really, when we're talking about what is there, it's real tangible things that hold their value or at least nominally increases as inflation or hyperinflation does its damage.
Yeah, I mean, to me, I think we've been saying a lot of the same things. I mean, this is it's always a dangerous time when the fear of missing out is far greater than the fear of loss.
Yeah.
And it's basic human psychology, and that's how really you're in a bubble. It's like people go, there's definitely excesses, and it's definitely feels a little pricey, but it seems like it could go up another 15-20%, and it's like as they say, nobody rings a bell at the top, and you don't really ever know. For us, I think I kind of tell people, I said, look, okay, your bank's paying 2 basis points, and so sitting on a bunch of cash in a bank account, certainly that's a shitty thing to do. But if all you're earning on cash is 2 basis points, you're really not trying hard enough. There are other options, and we've put a lot of our listeners into different things where we can do, for example, these like short-term secured loans where you've got real assets, gold and silver, for example, at 2-to-1 margins, 50%, 40% loan-to-value ratios, even less than that, 30% loan-to-value ratios, making 5-6% on something like that, even just over like a 6-month period. And you and I were talking that we're sitting on a shitload of 28-day T-bills, because however you feel about Donald Trump, he's probably not going to default on you in the next 28 days.
Right, and I've written about this for our audience. You can set up a Treasury Direct account in 5 minutes, and literally go from getting those 2 basis points to getting a percent a quarter.
Yeah, I mean the last one that I closed was just a couple of days ago was 1.8%, I think. Mm-hmm. So this is so you're talking about getting 1.8% without the same counterparty risk as you have to deal with. You don't have to accept your bank's balance sheet risk anymore. Not to mention they treat you like a criminal terrorist every time you want to withdraw your own money or do something just totally innocuous. They treat customers like they're criminals. But you can go from making 0.02% in your bank to making 1.8% just sitting in 28-day T-bills, and then mix that with some other options that some things that we're doing where you can make 4, 5, 6%, even 12, 13% on real asset-backed, very conservative, loan to value, short-term stuff. That is really stuff that favors. This to me is like the benefit of being a smaller investor. If you've got tens of thousands, hundreds of thousands, millions, potentially even low 8 figures, you can do things that are not available to Goldman Sachs. If you're the guys that have $500 billion, $1 trillion, $2 trillion balance sheets, you don't have a lot of options.
Right, it's hard to move.
You really don't have options. You're pretty much. I mean, if you're a European pension fund sitting on 400 billion euros, you don't really have a lot of options other than buying negative yielding 100-year paper and these sorts of things.
And just junk debt for 2%.
Right, junk debt for 2% because that's your only option because it's an asset class that's so enormous. But if you're a small investor, even if you got 10, 15, 20 million dollars, certainly if you have 200,000, 500,000, a million, 25,000. There are a lot of other options that are available to you to where on a blended rate, sure, you can make 4, 5, 6% without taking anywhere near. There's risk in anything that you do. There's always risk. There's risk in doing nothing. There's risk in holding cash under your mattress. There's risk in anything. So there's no such thing as risk-free. But you can really look at different options that are on the table that are really only available in niches that are small, that are only available to smaller investors, and blend these things together and have a very, very, very low marginal rate of risk and still make 6% on your money. And sure, maybe you're not making 10%, 12% in the stock market, but I'd rather make mid-single digit returns and very, very low risk than make 12, 13, 14%. And have all of my hopes and dreams pinned on the bubble continuing for another year. So to me, and one of the things we talk about a lot is all about risk-adjusted return. How much risk are you taking relative to every dollar that you're expecting or hoping for in returns? And if you're betting everything in financial instruments that are priced for, I like your word better, priced for fantasy pricing, you're really taking on extraordinary amounts of risk. And there are better ways, I think, to do that where you can still generate a perfectly reasonable rate of return while you sit patiently and wait. Buffett's sitting on 28-day T-bills. 28-day T-bills. Buffett's got $114 billion in T-bills. Buffett's not buying even 5-year notes or 2-year notes.
Or 6 months.
Right, or even 6-month T-bills. He's buying 28-day T-bills. It's got $100 billion worth of that stuff. So the best that he can hope for is 1 or 2%. He can't buy any of these other things. But I mean, it's because the most successful investor of our time knows that there's a correction coming and he wants to have all the ammunition there to buy up all that stuff. And if you look at it in the long run, okay, and again, for small investors, sure, we can average out to different instruments to make 4, 5, 6, 7% on these things without taking the risk and still having a lot of dry powder there. And if you look at it in the long run of, what's your sort of IRR of buying something at the top and then trying to smooth that out over the next cycle versus just patiently waiting, making smaller returns but still decent smaller returns, and then being able to just really come in heavy when there's a big correction and you can buy very high quality assets on the cheap. I mean, it really ends up being a much better return for you over the long term. We did a bunch of studies where we looked at investment returns for guys that bought not even at the top but within even 2 or 3 years of the top. If you bought in 98, or you bought in 2005, if that's when you bought, to see what your return adjusted for inflation, adjusted for tax, not even adjusted for risk, just tax adjusted, inflation adjusted returns. If you buy at the top and it's 2% or less, it's was it really worth the roller coaster ride to make 2%? easier, better ways to do that without having to take on that kind of risk and volatility. So.
Interesting.
Yeah. Dave Fairtex, who's one of the analysts that writes a lot at our site, has done some backdated analysis like the sort you're talking about. And, it's not necessarily what I recommend, but I really like the spirit of it, where he's realized, kind of to your point, where nobody can really effectively time the market, with consistency, but you can. It's much easier to identify when you are in the territory of a cycle high or a cycle low.
Yeah.
And he's done the numbers and basically said, if you can be patient, there is an investing strategy where you basically get out, when the markets are approaching all these overvalued metrics. And there are times when you can buy in when the undervalued metrics are, relatively clear, certainly, relative to what they were when you were at a high.
Right.
And you may only need to make, your trades like once every 7 years.
Right. Exactly.
And it's just like, can you?
And then just don't check your account.
Exactly.
Yep. It's like what Taleb says. What does he say? Your satisfaction with your brokerage account is inversely proportional to the number of times that you log in and check it.
Which I think has real truth. And of course, humans being humans, our human nature works against us, in so many areas, and that's one of them. But if we could just literally get comfortable with that, I think most people would probably do a lot better in the long run.
Yeah. Well, I'm on year 16 now of one of my trades, which is gold, which I bought at 300 principally, right? Got in.
Worked out well for you?
Well, so far, but it's been very frustrating these past few years, watching it just sort of get hornswoggled and constrained and
languish a little bit.
Languish quite a bit. And, particularly, with the macro trends around it, like looking for the flow of gold from west to east, right? Our vaults are just emptying. One of the more telling things was talking with a gentleman last year who runs a refinery saying, we're getting, in Switzerland, he's saying, we're getting bars now, where they check the numbers, right? And you can track back the serial number on the bar, and he said, we're getting bars that were poured in the 50s and 60s now.
Wow.
Somebody's hitting the bottom of the vault, And they also have one other thing, which is an award. If any of the staff see a bar come in for remanufacturing that has a Chinese stamp on it, that they'll win something, because nothing leaves China.
Right.
They mine 400 tons a year. It gets minted, stamped, and it doesn't leave the country. So it's been interesting watching those giant flows.
Yeah, and just to talk about gold and silver for a minute, I think we're all fans of the precious metals, probably for a lot of the same reasons. But if there was, Simon, if we could have talked in 2008, and I'd said, okay, look, the central banks collectively, including China, are going to print up whatever it's been, 15 trillion or so in the next, 8 years, and you can only pick one asset class to own, what would it be? And I'm going to imagine commodities, or at least precious metals, might have been on your short list there, right? And if you look at, the performance of those guys over the past, at least the past 6 years or so, it's been really disappointing. And we can talk about why, but certainly in terms of value right now, particularly against the type of risk that we're seeing, I think the precious metals still offer a really good value at this point in time.
It's amazing. One of the only asset classes that hasn't peaked, it's reached some record high. It's been
hasn't shot the moon, and historically its job has been
almost everything else has just gone to the moon except for gold and silver. It's been, which to me means that it provides nominally some kind of unique and relative value there. Obviously, there are the reasons why you want to be in gold and silver to begin with, but just even as a speculation. For us, we always say, to me, I don't view gold and silver really as a speculation. My goal in buying gold isn't to trade paper currency for gold, hoping to trade it back for more paper currency later. It's just in a way it's a different form of money. I actually had this discussion with Jim Rogers once, and he said, "Well, do you think gold is money?" And I said, "Well, clearly it's not legal tender." We were at dinner we were having dinner in Singapore one night, and I said, "But at the same time, neither is my I've got a titanium credit card. It's like this isn't really legal tender either. I can't trade my credit card for something, but I could sure as hell use it, for something. I mean, my share of Apple stock isn't legal tender." But you better believe I could if I had a share of Apple stock, I could get rid of it pretty much 24 hours a day, anywhere in the world, for something else that happens to be the local medium of exchange wherever I happen to be in the world. And so all these things essentially are different forms of money, including gold and silver. And so to me, it's just sort of almost an emergency form of savings, that just certainly makes a lot of sense to hold. I got a friend. He says the reason he owns gold and silver is for the I don't knows. Will there be a war between the U.S. and Russia? I don't know. Will there be a war between the U.S. and China? I don't know. Will there be a massive correction? I don't know. And that's why I own gold, because I don't know. And it's it's a great insurance policy for a lot of those things. And he says, I hope one day my grandkids discover all these gold coins that I have and wonder, Grandpa, why did you ever buy those things? They're just sort of these cute little trinkets that the grandkids stumble across and have no idea why. And he says, I hope that's the case.
The hope that the world hadn't gone to hell.
Exactly, because that means that everything sort of turned out okay. Yeah. Which is why I think, to me, it's like any type of insurance. You never have 100%. You never have an insurance policy that's like 100% of your portfolio. I mean, it doesn't really make sense to be 100% in anything.
Right.
I don't think you have 100% in anything. That's no longer an investment. That's a fanaticism into something. That's to think that there's 100% certainty in any one thing.
Absolutely.
Is crazy. We think about an insurance policy of any kind. A fire policy on your house costs like 1 or 2% of your home's value. For collision insurance on your vehicle might be 4 or 5% or something like that. So certainly to try and insure 100% of your wealth with 100% gold position seems like that's quite excessive. I think certainly having some ownership in gold and silver makes a ton of sense.
And those are two words for me: gold and silver.
Sure, exactly.
And a lot of the work that we do at Peak Prosperity is around looking at resources and the depletion aspect. So when I go to a mining conference, one of my favorite questions to ask is, what are your ore grades?
Yeah.
And they're all just plummeting. In my lifetime, ore grades have come down by about 75 to 80% my lifetime. Right.
It's so funny though, because at those conferences, it's always the same guys telling the same story about pounds in the ground. Mm-hmm. I love talking to those the IR guys in the mining business, because they all try and say the same thing. Oh, we got 800,000 pounds of whatever. We just got to get it out of the soil. I go, oh, that's it. That's all you got to do.
Sounds easy, yeah.
Just scoop it up. Where do I sign? Tell me where to send the money, because they all have the exact same story. But I agree. Like if you look at the
silver's depleting, and I'm a big. So if you believe that the future is going to involve some sort of industry, silver is going to be part of that as the most reflective, most conductive, most amazing element for all sorts of new uses
in industry, right?
All that stuff, right? So I consider my silver holdings are going to be my family legacy in the sense that those trinkets you talked about, my great grandkids as yet unconceived or born, grandkids as yet unconceived or born, someday they're going to come across this big old stash of bars and coins, and either I'm that crazy great grandfather, right? So my legacy is assured, or I'm the genius who set the family up for the next 3 generations, and they can fritter it away and figure out how to be, more productive. And
the nice thing is,
one way or the other, this stuff it's just needed, and it's going away.
Yeah, I think you make a very good case on the industrial side of things for sure, especially that relates much more so to silver, and I think you're right. What you're saying that it doesn't really even require a big position to have that if the thesis plays out
it's like a very cheap call option.
Right, exactly. It's a very cheap call option. It's a very cheap call option on the future, and if it doesn't pan out, oh well. This is an asset. These are 2 assets that have had value and marketability for the entire 5,000 years of human history.
I just came back from the British Museum, took my 18-year-old daughter there. That's where she wanted to go. And we gravitated to the hoards, right? All these people had found hoards in England, and with their metal detectors. And so you'd see these extraordinary displays of like all these arm bracelets and neck torques and bits and pieces. And so we were looking at one of the larger hoards, it was 44 kilograms. And my daughter was like, oh my God, can you imagine finding this? And I was like, 44 kilos of silver? It's not that hard to come by.
Nice.
So she was all of a sudden, her eyes widened. She was like, holy shit, our family hoard is way bigger than this one. I was like, yes, it is.
Yeah, right on. Fellas, I think we got to probably cut it off. I haven't even packed yet.
All right.
So I'm a very bad boy. Final thoughts, Adam?
Well, I'd love to have another conversation at some point in time, one, because you're such a great thinker, Simon, and just a good guy to hang with. But
we had a lot of fun.
Clearly, I'm looking forward to having more fun together with you. But we haven't really gotten to the thing that, I think makes what Chris and I do at Peak Prosperity, more differentiated than the other economic speakers here at the conference. Because really what we like to do is talk to people about the resilient living side of the equation.
Sure.
Because we think that that's, to your point, there's no guarantees. nobody should have all their eggs in one single basket, and that includes, money alone. And there's a lot of other aspects of life that, we don't know. For the don't knows, we don't know what's going to happen.
Right.
But there's a lot of things you can be doing in all the other elements of your life that will, give you protection and maybe give you even some upside. Should some of these nastier things that we were sort of speculating about might happen. But the best part about them is, even if they don't, almost all those steps are life enhancing.
Right.
And I think you're somebody who embodies that in your own lifestyle and what you've done down in Chile. So I'd love to dig into that more deeply with you. Really to get to learn more of your story at some point too.
Definitely. We say the same thing all the time in Sovereign Man. It's like, you're not going to be worse off for doing X, Y, and Z. We take quite a lot more international bend. I mean, we talk about things like, and there are, for many people, very simple ways to obtain something like a second passport. Some people are in line for it just because they have a grandfather who's Irish or Polish or something like that. To say there's literally no downside in having this document that says that you're welcome to go and live and stay and work and invest and bring your family and so forth. That's something that entire future generations of your family that won't be born for decades will be able to enjoy because you spent a little teensy bit of time and effort and research on something today. There's no downside to that whatsoever. In my case, I spent a lot of my time on an organic farm in central Chile, growing basically pretty much 100% of everything that I eat is just grown right out of my own soil, organically. Not a lot of downside there. I'm eating healthy, and if the entire world goes to shit, I'm not really going to notice with respect to, my own personal livelihood and so forth. But I mean, look, even if everything's great and the unicorns and the rainbows do come out and it's all gravy, I'm not worse off, eating organic, healthy food 7 days a week, 3 meals a day.
And employing people in your community and, becoming more valued there. And it's just, to your point, there's really no downside to not doing it.
Chris, final comments?
Well, this is obviously a conversation that just got started.
Yeah.
And
we didn't even talk about crypto.
That's right.
It's been a popular topic on the cruise so far.
And there were a few insights from Doug Duncan, the Fannie Mae economist, we didn't get to. So lots more to talk about, obviously. So really looking forward to this next few days together. And
definitely. Maybe we can sit down and do this again on the boat when we're at sea, or just kind of take a breeze one day.
Absolutely, absolutely. So with that, this has just been fantastic, good conversation. Yeah. And thanks for arranging it.
Yeah, good stuff, guys. Okay, time to pack.
All right.
Thanks, everybody, for listening.